Hi, welcome to another episode of Money Related. The idea of having a debt is generally synonymous to having a burden, which many would definitely love to avoid if it were possible. It's true that debts have ruined so many lives, so it comes as no surprise that at the mention of the word debt, many think of it as something negative. And I know it would sound counterintuitive to hear that having a debt is a good thing. What many people seem not to get is that there are two types of debts: good or commercial debt and bad or non-commercial debt. And it's how risky and costly a debt actually is that determines how bad or good the debt is. When you take too much risk by taking a loan without the ability to repay, it makes debt a bad thing to have. When a debt is also too costly due to high interest rate, it is also considered bad. Therefore, high cost and high risk is what makes a debt bad. A good or commercial debt would be the reverse of a bad debt. To be able to make money out of debt, it's important to know what clearly differentiates the two types of debts. It's true that not all debts are good. If your debt is meant to buy things that don't generate income, which will help repay the loan, then this type of debt is definitely a bad one. To be more specific, if your debt doesn't get assets that appreciate in value, then don't go for such debts, if possible. And plus, a debt is also considered good if the interests on them are tax deductible, an advantage bad debts don't have. And so, this video is not meant for those who have or plan on taking a credit card debt, a car loan, and a loan to support their living expenses. These type of loans are inherently bad and won't help grow your wealth and make you rich. Rather go for property, shares, and managed funds debts. And this is what this video is all about. So, make sure to watch it to the end to know how you can make a fortune out of these types of debts. Here are the 4 main ways you can use debt to make money. But before we jump into that, note that all of these strategies make up what is known in finance as leveraging or gearing, which in simple terms refers to all strategies of using borrowed money or other financial instruments to increase an investment's potential return. With that said, now let's jump into the business of the day. Number 1. Margin investing. This is simply the act of borrowing money from a broker to buy marginal securities like stocks and bonds. This method of taking up a debt permits you have more assets available to buy these marginal securities, as it increases your purchasing power. This is so because with margin investing, you can borrow up to 50% of the purchase price of new marginable investments. But first, you must create a margin account, which is different from your traditional brokerage account. With that done, now, if you want to buy a security that costs, say, $10,000, and you have, say, $5,000 cash in your margin-approved brokerage account, you can use $5,000 cash to purchase the security, while your broker lends you the remaining $5,000, while using the stock you are buying as collateral security for the loan. Buying on margin can amplify gains when the price of a security such as a stock is rising, but it can also magnify losses when that security falls. Number 2. Short selling or shorting. This is where a trader bets on a stock with the hope that price of the stock will fall in the future. The investor goes on and borrows a stock from his broker and sells it immediately in the open market, and when the price of the stock eventually drops, he buys it back at a lower price than he initially sold it for. He can then return the stock to the broker, whilst making a profit equals to the higher selling price, minus the lower buying price. But woe betide you if the stock price instead rises. Your losses could be enormous. Number 3. Hedge funds. Becoming an accredited investor with a hedge fund can be quite a lucrative venture. Given that hedge funds are known to employ a combination of riskier strategies, shorting and even leveraging, to make good returns for their investors. But if the fund manager misses on his strategy, the losses one could incur from a hedge fund investment could be big. Number 4. Mortgaging. This is a financial leveraging strategy that allows you to buy property or real estate by taking up a loan and using that property, be it a house, land, or other types of real estate as collateral. This strategy can spare you the stress of trying to save up to buy the property 100% in cash. With this strategy, you can be able to acquire an asset quite faster and be able to repay the loan and the interest from the income you shall make by reselling or renting out the house or piece of land. Debt can be a very strategic tool in building wealth and getting rich, but like any other financial instrument, its usage comes with risk. And so if not used wisely, it can lead to enormous financial turmoil. With that, we come to the end of this episode of Money Related. If you like this video and would like to watch more on how to become rich, I will leave the link of a video we did about the 10 fastest growing industries that can likely make you a millionaire in the description and on the end screen displaying on this video right now. And until the next episode, peace.